Welcome, investors, to a deep dive into the timeless investment wisdom of Warren Buffett, the billionaire philanthropist and sage whose name is synonymous with success in the world of finance. Over the years, Buffett has earned his reputation as one of the most astute investors of all time, consistently outperforming the market and amassing a fortune through his shrewd investment decisions. But what is the secret behind Buffett's success? Is it his intellect, his intuition, or perhaps a stroke of luck? The truth is, Buffett's winning streak can be attributed to a set of 7 timeless investment rules that he has honed and perfected over the course of his legendary career. In this video, we'll unravel the mysteries behind Buffett's 7 rules and explore how you can apply them to your own investing journey, starting in 2024 and beyond. From the art of capital preservation to the importance of investing in businesses you understand, each of Buffett's rules offers invaluable insights into the world of investing. So join us as we dissect Buffett's playbook step by step and uncover the strategies that have made him a true master of the game. Remember, while Buffett's rules may be timeless, success in investing requires discipline, patience, and a willingness to learn from both the triumphs and mistakes of the past. So without further ado, let's dive into the first rule in Buffett's playbook: don't lose. 1. Don't lose. At the core of Warren Buffett's investment philosophy lies a simple yet powerful principle: don't lose. This mantra underscores the importance of capital preservation and risk management in the world of investing. Buffett famously quipped, "The first rule of investment is don't lose, and the second rule is don't forget the first rule." While it may sound like common sense, the significance of this rule cannot be overstated. In a market driven by uncertainty and volatility, avoiding losses is often more crucial than chasing after big gains. Buffett advocates for a cautious and methodical approach to investing, urging investors to prioritize the protection of their capital above all else. By focusing on high-quality businesses with strong fundamentals and sustainable competitive advantages, investors can mitigate the risk of significant losses and position themselves for long-term success. Buffett's own investment portfolio is a testament to this principle, with holdings in companies like Coca-Cola, Apple, and Visa that have stood the test of time. So the next time you're tempted to take a gamble on a speculative stock or chase after the latest market trend, remember Buffett's timeless advice: don't lose. By staying disciplined and sticking to sound investment principles, you'll be better equipped to navigate the ups and downs of the market and build a solid foundation for your financial future. 2. Invest in businesses you understand. Moving on to the next rule in Warren Buffett's playbook: invest in businesses you understand. While this may seem like a straightforward concept, it's one that many investors overlook in their quest for quick profits. Buffett emphasizes the importance of having a deep understanding of the companies you invest in, including their business models, competitive advantages, and long-term prospects. Too often, investors are lured by flashy headlines or hot stock tips without fully grasping the underlying fundamentals of the businesses they're buying into. Buffett warns against this approach, advocating for a focus on businesses that you can evaluate with confidence and clarity. By investing in businesses you understand, you'll be better equipped to assess their potential for long-term growth and profitability. Buffett himself has built his fortune by sticking to this principle, favoring companies like Coca-Cola and American Express that he knows inside and out. So before you hit the buy button on your next investment, take a step back and ask yourself, do I truly understand this business? If the answer is anything less than a resounding yes, it may be wise to reconsider. By following Buffett's advice and sticking to what you know, you'll be on the path to building a more resilient and profitable investment portfolio. 3. Think long-term. Now let's explore the third rule in Warren Buffett's investment playbook: think long-term. In a world where market fluctuations and short-term thinking often dominate the investment landscape, Buffett's emphasis on long-term investing is a refreshing reminder of the power of patience and perseverance. Buffett famously quipped, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." This simple yet profound statement encapsulates Buffett's approach to investing, which prioritizes the compounding of wealth over time. By taking a long-term view of their investments, investors can avoid the pitfalls of short-term thinking and capitalize on the power of compound returns. Buffett's own investment journey is a testament to the effectiveness of this approach, with holdings like Coca-Cola and American Express that have been held and compounded for over a decade. So the next time you're tempted to make a short-term trade or chase after the latest market fad, remember Buffett's sage advice: think long-term. By focusing on the fundamentals and staying patient through market ups and downs, you'll be better positioned to achieve your financial goals and build lasting wealth for the future. 4. Always buy below intrinsic value. Moving on to the fourth rule in Warren Buffett's investment playbook: always buy below intrinsic value. At the heart of Buffett's approach to investing lies the concept of value, which he defines as the intrinsic worth of a company independent of its market price. While the market may fluctuate based on sentiment and speculation, Buffett remains steadfast in his belief that true value lies in the underlying fundamentals of a business. By focusing on companies whose intrinsic value exceeds their market price, investors can position themselves for long-term success. But how do you determine a company's intrinsic value? For Buffett, it's all about estimating the future cash flows of a business and discounting them back to their present value. By conducting a thorough analysis of a company's financials and competitive position, investors can identify opportunities to buy low and sell high. Buffett's own investment track record is a testament to the effectiveness of this approach, with holdings like Apple and Coca-Cola that were purchased at prices below their intrinsic value. By following Buffett's lead in buying below intrinsic value, investors can increase their margin of safety and reduce their risk of permanent capital loss. So, the next time you're considering an investment, remember Buffett's timeless advice: always buy below intrinsic value. By focusing on value rather than price, you'll be better equipped to identify opportunities for long-term wealth creation and financial success. 5. Be greedy when others are fearful. Now, let's turn our attention to the fifth rule in Warren Buffett's investment playbook: be greedy when others are fearful. In the world of investing, emotions often drive market behavior, leading to irrational swings in stock prices and opportunities for savvy investors to capitalize on fear and uncertainty. Buffett's advice to be greedy when others are fearful is a reminder of the importance of contrarian thinking and the value of buying when others are selling. By remaining calm and rational in the face of market volatility, investors can position themselves to take advantage of mispriced assets and generate outsized returns. During periods of market turmoil, Buffett has famously deployed his considerable capital to scoop up bargains and acquire quality businesses at discounted prices. From his investments in Goldman Sachs and Bank of America during the 2008 financial crisis to his recent bets on airlines amid the COVID-19 pandemic, Buffett has demonstrated time and again the value of contrarian investing. So, the next time the market is in panic mode, remember Buffett's sage advice: be greedy when others are fearful. By maintaining a long-term perspective and staying true to your investment thesis, you'll be better positioned to capitalize on market dislocations and build wealth over time. 6. Think long-term. Continuing our exploration of Warren Buffett's investment rules, let's delve deeper into the sixth rule: think long-term. Buffett's emphasis on the importance of taking a long-term view in investing is a cornerstone of his philosophy. He famously said, "Our favorite holding period is forever," underscoring his belief in the power of compounding and the value of patience. In a world where short-termism often dominates investor behavior, Buffett's approach serves as a powerful reminder of the benefits of staying the course and resisting the temptation to chase after quick gains. By focusing on the underlying fundamentals of a business and ignoring short-term market fluctuations, investors can position themselves for long-term success. Buffett's own investment track record is a testament to the effectiveness of this approach. His holdings in companies like Coca-Cola and American Express, which he has held for decades, have generated substantial returns through the power of compounding. By allowing his investments to grow and compound over time, Buffett has been able to achieve outsized returns and build lasting wealth. So, the next time you're tempted to make a short-term trade or react impulsively to market news, remember Buffett's sage advice. Think long-term. By maintaining a long-term perspective and focusing on the fundamentals, you'll be better equipped to weather market volatility and achieve your financial goals in the years to come.